Alright, so in this video, I'm going to walk you through an old tenant health worksheet that I shared a long time ago on the site. I recently dug it up and I spent some time giving it a makeover, and I decided to put together a video for it because I actually thought it's pretty cool. So this module looks at the health of a particular publicly traded tenant at the company-wide level, not at the individual property level. So in addition to understanding how the tenant is performing at the property, it's important to know how the tenant is performing as a whole, as this can have huge impacts to your property regardless of how well the single store is doing. So this tool can be used for any publicly traded tenant you might have in your building that you're underwriting. This goes for office or retail or even industrial. It allows you to get a benchmark understanding of how they size up relative to their industry. Now, this tool has basic inputs when it comes to industry benchmark data on the back end, and I'll walk you through that in a little bit, what's in it now. But I view this sort of as a starting point for me to continue to develop over the years. And also, this is something for anyone to take and go crazy with it. So if you're finding value in this, you could go into the back end. And when I say back end, it's really just the data that's down below here. So there's really not much back into it, but you could take it and go crazy with it and build it out and make it more robust. So what I'll do in this video is what I'm going to use a live 10K from Burlington Coat Factory, and I'll use it to fill this template in. And I'm not sure if I need to say this, but just in case, I'm in no way affiliated with Burlington Coat Factory. And in fact, I actually have no idea how this is going to turn out for them. So it's a mystery to me what we're going to find out here. And so what I'll do in this video is I'll provide a walkthrough of what this module is. And then we'll go to the 10K and we'll begin filling in the inputs to then analyze the metrics. All right, so taking it from the top here, first we'll fill in our basic tenant information, so we'll put the company name in. And then here we have retail type. And so for now, all I have are 4 subcategories of retail. And what happens is as you update this, you'll notice here our industry benchmarks get updated. And so what this is doing is it's basically pulling in from our very basic data table down here, and it's pulling in the metrics for each of these retail subcategories. And again, this is where I said it's very basic, and over time this could become very robust. You could have subtypes for grocery, subtypes for restaurants, and the sky's really the limit. But for now, it's really just a basic start. So moving to the next section here, credit rating agency grades. So if they have debt, that debt is typically rated by these credit agencies, and if they don't, then they're not credit rated. They don't have any debt, which is great for solvency purposes, but there is no rating on them. So a lot of times there is, and so we'll click yes, and then we can go to the agency. So there are 3 credit rating agencies: Fitch, Moody's, and S&P, and they have various grades, and if they're above certain grades that are assigned by each of these agencies, they're considered investment grade. So Fitch and S&P, if you're above a BBB minus, you're investment grade, and then Moody's if you're above a Baa3. And down below here, you'll see as part of the data, you'll see Moody's, S&P, and Fitch, and these are their ratings. And again, as you go up the scale, it's better. As you go down the scale, it's worse. And so this line right here is where the cutoff is for investment grade and non-investment grade. So sometimes you may have tenants that are straddling, and Fitch and Moody's might have BBB minus. Fitch and S&P might have BBB minus, and Moody's might have this company as a Ba1. So again, something to consider and look at when you're analyzing these tenants. So under that, we have our inputs from the financial reports. And so here's where we're going to go to our 10K from Burlington Coat Factory, or Burlington Stores Incorporated, and we'll begin to fill in all this information. And as we fill this in, numbers will start to populate over here, and we'll be able to analyze how Burlington Coat Factory is comparing against other apparel stores. All right, and then the bottom here is basically the database that we're starting with for the industries. All right, and that should be everything. And I think now we can get into filling this out. All right, so let's start off. We're going to fill in total assets. So we'll come here, and what I like to do, I just do Control F and just type total assets, and it will usually take us right there to the balance sheet. And so for now, and see, there's 3 instances where total assets occur. So it looks like there's only 2 years of, oh, no, here we have 5 years. All right. So let us do, and it looks like they have 2020, so January 30th, 2021. So we'll just assume that's year 2020. So let's take the 4 years of total assets, and we'll start to fill in. And you know what, rather than you guys watching me fill all this info in, I'm going to pause the video, and then once it's filled in, I'll come right back. All right, so I've gone ahead and filled that in, and now we're going to find current assets. So I'll just type current assets up here, and you'll see here we have total current assets down here. Now let's just check to make sure we don't have more than these 2 years of current assets available. This is cash flow statement, so we won't see current assets there. Okay, so we only have 2 years, which is fine. All right, so total current assets for 2020, 2510,616. And then 1417371. All right, so it's the same process. You can find all this stuff. I really just should be in the balance sheet looking for, so next thing will be inventory. So I'm going to get that. I'll get cash and cash equivalents. I'll fill that in. Any prepaid expenses, I'm going to fill that in. I'm going to fill all of this in. All of this stuff, again, is here on the balance sheet. So I'm going to pause. I'm going to fill all it in, and then when that's done, I will come back. All right, so we're back, and I have this completely filled in with all the data I could find. There were some interesting updates. I can walk you through some of the differences. All of this was straightforward. There was long-term liabilities. You'll notice here there's typically a sum up of long-term liabilities, and they basically avoided doing that and decided to do total liabilities and stockholders' equity down here. But they summed up total current liabilities, left long-term liabilities out, and just summed up stockholders' equity. So there's probably a better way to do this. I went and hard coded all of them. There could be errors here. Hopefully not. But that's what happened there. That was a unique issue for long-term liabilities. Cost of goods sold were simply, and this is in the income statement. Oh, I think I'm going the wrong way here. Yeah, so I just took cost of sales, which is right here. And then OpEx was unique because I had to take all the line items and exclude interest expense to get to earnings before interest and taxes. So that's that. Then I added the interest expenses back in. and then the inputs for tax, and then we came to our net income. And then I had to go searching for depreciation. Everywhere it's aggregated together with depreciation and amortization, but somewhere in the notes you'll be able to find exclusively depreciation. All right, and so that's everything now. Let's come over here. We can do the analysis before we come back in and put the credit ratings in. So I'll start with solvency. To me, as when I think of real estate, I'm in the 50 to 70% world of debt on an asset. But here, which is kind of the same for apparel stores, as we're looking at the industry benchmarks, and you'll notice Burlington Coat Factory is alarmingly higher. Their debt ratio is 95% in 2019 and 90%, which the trend is going down, so that's good. And again, this equation is it's like a loan to cost or loan to value. It's total liabilities less total assets. Now, there's a lot more wrapped up in liabilities other than just debt obligations, but nonetheless, that debt ratio is rather high. The interest coverage ratio is looking great for them up until COVID. So again, the interest ratio here, you'll see it's EBIT divided by interest expenses. Yeah. And so it looks like they're sufficiently able to cover, and then as of COVID, there's been some concerns. So what I would honestly do looking at this whole thing, now this model is built to show you if anything is outperforming, it'll turn green. And so noticing that nothing is green here in the far column, in column N, I would probably go and look at some more financial statements, see any quarterly reports, and take this another step, because noticing some trends here, that who knows what's happening, because COVID was such an issue, and now there's a lot of rebounding happening all over the board. So I would probably look deeper. This might be not looking great, but inconclusive. So anyway, we'll keep going. Solvency ratio, again, this is negative, which is not great, because again, they had negative net income for 2020. And anything again, so with solvency, what it is, this is adding back depreciation to net income, because depreciation is not really a cash expense. It doesn't actually hit cash. And so you add it back. So you take net income plus the depreciation that was netted out, and you divide it by total liabilities. And the solvency ratio should be greater than 20 across all industries, or greater than 20%. And so you'll see this again is not looking great. Their current ratio again is under the industry benchmark, the quick ratio, the cash ratio. And I'll walk through these ratios real quick. So current ratio, current assets divided by current liabilities, under the industry benchmark. The quick ratio is current assets less inventory less prepaid expenses, divided by current liabilities. So you're basically taking out anything that's not easily converted to cash. So that's what the quick ratios does. Taking out inventory, it might be hard to sell that. You're taking out prepaid expenses because it's just cash that's out. It's already been paid. And the cash ratio is just direct cash and cash equivalents, divided by current liabilities. And again, this one is close to the industry benchmark, but you'll notice they're trending in the right direction here. So cash ratio should be increasing. All of these are going upwards. And right here's probably a typo. If I had to guess, it's probably 1.13. So yeah, so it's somewhat inconclusive on liquidity. And then profitability metrics, you'll see that they were doing okay, across the board up until the pandemic. And here we don't have industry benchmarks for comparable store sales growth for apparel, at least at this moment, at the time of this recording, so it's not in there yet. And actually, I should make these are blue cells. So they're direct inputs, so... Oh, that's right, it's conditional formatting. Anyway, so I guess we'll keep it. The blue background should hopefully inform you. So yeah, all in all, just looking at this without understanding the credit ratings, without reading reports, which I'd recommend you do as well, kind of see where people are thinking this company's headed, I'd be somewhat concerned about this tenant being a major tenant within my shopping center. All right, so let's come back up top here and we'll fill in our credit ratings. So I'm trying to go about doing this with all free resources. And so what I'm going to show you is one way that I was able to solve for not having access to Bloomberg or Capital IQ or services like that. There may be a methodology out there, or there may be resources out there that I have yet to find that are free. That's more comprehensive. So I had to utilize a couple different resources to get the results. So you're going to see how I did this, and if I come across a better methodology without having to pay for any subscriptions, I'll share that as well. So what we'll do for Burlington Coat Factory or Burlington stores is I pulled up a couple websites that I like to search around. So this FINRA website has a location where you could search bonds. Now, again, these are what the credit rating agencies are rating. They're rating the ability for these companies to pay back their debts. And so you can see I've already come here. I've already searched Burlington. So this is something you got to be careful for when you're searching for this stuff. You might type Burlington, and you'll come here and you'll see all these credit ratings, and you'll think, okay, this is the right thing because Burlington Coat Factory is so prolific. There's probably no other Burlington company out there. So I just wanted to make you aware there's a bunch of other companies that use the name Burlington, or at least 3 that are on this page that I'm looking at. And so with that, we need to make sure we edit our search to get the exact info we want. So I'm going to do Burlington stores. And you'll notice here, for this particular example, this FINRA page is not showing me any ratings. But for some companies, this will work. So you'll see we had, I put down here already, see I've searched Target or Microsoft. So you could put Target. And you'll see a lot of their corporate bonds, you'll see their rating right here with Moody's and S&P. So this came up empty for me for Burlington stores. So the next thing I went on one of my trading accounts, and I tried to search up Moody's research reports on Burlington stores, and I didn't find anything here. So then I went direct to Fitch ratings, and I didn't get an exact rating, but what I found was a news clip that basically says that Fitch affirms Burlington Stores Inc. at a BB minus, withdraws all ratings. So the BB minus says a negative outlook down here, which is something interesting to note. So I found my first rating, which was a BB minus for Fitch. And this, again, is not investment grade. So this will read no. And then Moody's and S&P, if you try to search on their sites, you need a login. So you're not, at least I'm not aware of an ability to go and find these credit ratings on their site. So those were my options that I used. I exhausted them. And then I have one final option here, which is this little single tenant net lease retail website. I'm actually not sure how little it is. Probably could be quite large. But nonetheless, they have a great page here that shows all the tenant credit ratings, at least for Standard & Poor's and Moody's. And so And again, if you have tenants that are subsidiaries and they're not showing up here, they have a whole other section here that helps you find who the parent companies are. So Chili's, you'll kind of see where they land. And so I'm going to go down to Burlington, and here, Burlington Coat Factory Warehouse. So Burlington. So you'll see here we have a double B and a BA2. So that's a double B for Standard & Poor. And then a BA2 for Moody's. All right, so none of this is investment grade. None of these ratings are investment grade. And so, yeah, so, you know, in addition to what we analyzed over here, we could see that this is not an investment grade tenant at this point. We even saw that Fitch had a negative outlook. So again, to me, I check if there are additional reports that have come out. Again, the last year we really analyzed was 2020. There's been a whole year that's passed. There's been quarterly reports. And so the next step would be to really go and see what's going on today and see how all these metrics are trending as of the latest report. All right, so that's everything. I hope that was helpful. Again, this is a start, and I'm excited to build this thing out and make this a lot more dynamic and more robust. So thanks for watching, and I'll see you in the next video.